Now, today we are discussing uh, another important component of the financial system, that is financial institutions. Uh, when we discuss these financial institutions, we will also cover most of the financial products, markets to some extent, because these are interlinked. When we talk about these things, I think that will also cover financial markets and uh, instruments to some extent. But we will have separate sessions on those two aspects. But keep that in mind as well. We will have some discussion on those things here as well. So I think you remember we defined financial institutions, or we identified different financial institutions in the economy, in the financial system. From previous week's or last week's discussion, we also looked at central banks. So central banks are doing central banking. We already covered that part. So as the main financial institutions in the economy, or apex financial institutions in the economy, we have some understanding about the central banks as well. But in this session, we are looking at uh, other financial institutions other than the central bank. Because in the economy, if you look at even in the case of Sri Lankan economy, we saw only 10% of the assets of the financial system is related to the central bank. So other 90% is with other financial institutions. So these financial institutions we can broadly identify into two categories, within two categories, that is financial intermediaries, and then we have financial service providers. So intermediaries are basically into the business of intermediation. We already know what is intermediation and why it is important, how it works. We have some idea. Then we have financial service providers. They are basically providing payment services. So today in this lecture, the task is to look at these two types, intermediaries and service providers, under this broad definition of financial institutions. Financial institutions are providing various services. If you take out the central bank and if you look at only other financial institutions, which are these intermediaries and payments service providers, which we call them as FIs in general terms, they provide one or more of the following services. For example, some institutions provide financial intermediary services, which means they connect providers of funds with the users, which means they connect surplus units in the economy with the deficit units and create new financial assets. That's one type of business. Some institutions are helping to exchange the financial assets, which means they are acting as brokers and agents for clients. At the same time, some are helping to create, buy or sell of financial assets in different markets. For example, there are players who underwrite new shares. Underwrite new shares means they facilitate the share issuance, and in the case of the share issuance, if it is not fully sold or subscribed, the remaining unsold part is basically purchased by these underwriters. those are also some sort of service. And there are some institutions providing investment advice, advice on personal pension firm, pension schemes, or in order to merge two institutions. For them, these institutions provide investment advice. And some are carrying out fund management activities. Fund management means they are helping to invest their funds, generate returns, invest in a prudent manner, which means with less risk and high in return. For those matters, some are advising. So, depending on this type of actions, uh, the type of financial institutions would be different. You can also add here some are providing payment instruments, right? For example, some companies are there to provide credit cards, debit cards, or any other electronic fund transferring facilities are provided by them. So by looking at them, you can identify which type of financial institutions are they by looking at their activity. Now we already know intermediaries, they are actually institutions providing or connecting surplus and deficit units. From our very early discussions, we have seen they are helping to link the lenders in the economy. Lenders means people who are having some surplus money. They lend them in the financial system to generate an outcome, a return with an acceptable level of risk. And there are some institutions or some people they borrow who are the spenders of the economy. So role of the financial intermediary here under direct indirect finance we have seen to connect them. So in that sense he is providing indirect financing as a financial intermediary. This we have covered or discussed sometimes back. I think you remember this. Now, when they are connecting this deficit surplus units and the deficit units, or in other words, when they do this intermediation, what they are trying is trying to match certain requirements of these two parties. Certain requirements of financial intermediaries match some conditions of the lenders and borrowers. So, what are the requirements of a lender? He would like to have a return out of his investment. When he give away money to someone, his excess money, he would like to have a return to compensate his money. At the same time, so he is trying to maximize his return. So he tries to maximize his return subject to what? Subject to some acceptable level of risk. He wants to generate a return, but subject to a certain risk. He tries to minimize that risk. Risk can be in various forms. Could be credit risk, could be liquidity risk. Likewise, there could be various aspects of risk. Then he tries to ensure the liquidity. Liquidity means basically when he gives back the loan, he is expecting money back when he needs. So some sort of liquidity is expected by him. which means some high liquidity is expected by him. Transaction cost. So when he enters into a transaction, he would like to minimize the cost that is paid on the transaction to find out the borrower, to do so the to do the due diligence. Due diligence means you look after in all aspects. You do some evaluation to process the financial transaction. Some cost is involved, but he tries to minimize that. So he attempts to increase the expected return, reduce the risk, increase the liquidity, and reduce the transaction cost. From the borrower's angle, he is also having some reasonable requirements. What are they? He is paying an interest for his borrowing. He tries to reduce that interest as much as possible, which means what he pays back is expected to pay with less cost. So borrowing cost, he is trying to bring down the borrowing cost as the borrower. Term means the maturity of loan. When a person borrows, he would like to borrow for a maximum period. Right? The person who lends, he will have the expectation of shortest time. That's why he is looking at liquidity. But the borrower, he tries to borrow long. Transaction cost, he is also trying to reduce transaction cost. The size of the loan, he would like to borrow as much as possible. When he asks for a loan, let's say for 100, he would like to have that 100, even more. He would also like to reduce risk, not the default risk, but some sort of risk could be there from his end as well. So these are the requirements matched by a financial intermediary in a transaction. In that sense, we can identify certain key roles of financial intermediary. So this slide is a bit important. I'm putting a star mark here because in some exam papers, you have this question. What are the key roles played by a financial intermediary? So we can identify some key roles in relation to their activity. You can also expand this into the broad economy, but here we are first looking at why they are important for this intermediary business. So they help with maturity transformation. Maturity transformation means they convert short-term liabilities to long-term assets. Short-term liabilities are basically, for example, if you take a bank, so short-term liabilities are deposits, right? So they collect deposits and give them as loans, which are long-term assets. This situation we call it as maturity transformation. Then we have risk transformation, which means they are converting risky investments to relatively risk-free or low investments. How do they do it? Banks are, for example, banks are not giving loans only to one person. Without giving entirety to one person or a few persons, the bank is spreading the loan among multiple borrowers. Why do they spread it to multiple borrowers? To reduce risk. If a large borrower defaults, that is a huge shock. If a small borrower defaults, it does not have a substantial shock because the risk is spread. that we identify as risk transformation. Then financial intermediaries also help with convenience denomination. The idea is they are matching small deposits with large loans or large deposits with small loans. Now, in a financial institution, for example, for a bank, let's say, deposits could be thousands of deposits, small deposits, right? Whenever a bank wants to give a loan, maybe these few deposits are coupled in the sense they are pooled to give a large loan, loan one, loan two. Or there could be a large deposit that can be given as small loans, right? Loan one, loan two, loan three, likewise. That we call as convenience denomination. Another important role played by banks is they are solving asymmetric information issue. Now, this asymmetric information indicates the information gap, knowledge gap between the players in the financial markets. So, this knowledge gap, which means certain people have more information, some people have less information. So when there is a knowledge gap, what will happen that a transaction will not be efficient, the pricing will not be efficient. So to address it, you have to reduce the knowledge gap. Now because of this knowledge gap, in finance we theoretically discuss there are some two important issues arise. I'm not going to discuss these issues in detail, but for your knowledge, what are these two issues? If you turn a financial textbook, you will see there are two issues discussed in the finance in relation to asymmetric information. First one is adverse selection. Second one is, sorry, moral hazard. Adverse selection and moral hazard. What is meant by adverse selection? This happens, for example, in a bank, before the loan gives, this happens. How it happens? Some people, they know they are not in a capacity to borrow. They are not in a capacity to borrow. They know there is a possibility that they will default. But still, they borrow. They know they are going to default or there is a possibility of defaulting, but still they borrow. So this happens before the transaction, before the loan, adverse selection. The second situation is moral hazard that happens after giving the loan. The person who borrowed default willingly. Oh, that will create impact on others as well. Moral hazard. So these two will lead to a substantial problem of credit risk and default. So credit risk is one of the key risks faced by financial institutions, which means they will not receive their money back. That's a huge risk. So this is addressed through the reducing knowledge gap between each party of a transaction. So how do you address? You provide information, you generate information, you analyze the borrower, you publish information on borrower, you look at past credit history of the borrower, you do some credit appraisal, scoring. A lot of things can be done to assess the borrower or the party that involved in the financial transaction, that is involved in the financial transaction. So this is basically through providing information. So these roles are important in terms of the financial intermediaries role in their business. Why do we need them in a broader scale? We have seen financial intermediaries have some cost advantage over the direct lending or borrowers. So if you go to this picture again, this direct lending means happening
Excuse
in,
me.
yes,
Sir, can you explain the moral asset again?
moral asset means it happens after the transaction, right? You get the idea of adverse selection, right? It happens before the transaction. Moral asset happen after the transactions. Why it happens? The other party has not entered into the contract with good motive, and at any time he might default. So he is aware of that. So when it happens, sometimes there is an incentive to others also to uh, default. So that creates, as I said, credit risk to financial institutions. Clear?
Okay, sir, thank you.
Okay. So these financial intermediaries, now what we have discussed, all these actually related to their business. Now, in this slide, again, this slide is also important in terms of the role and the importance of financial intermediaries. Here we are looking at some broader, uh, uh, advantages. What are these advantages? There is a cost advantage over direct lending or borrowing. Direct lending means direct financing. People meet in the market directly without any intermediary. So when they come to the market, people have to work out on their own. They have to analyze the market. They have to get information. It's a kind of a some costly uh, business. Even the people who are borrowing and lending, they do not know full information about the parties in a direct market. If you take the stock market or the bond market, it's a direct market, direct financial transactions without any intermediary. Intermediaries can support, but if you take a kind of a stock market, there is a in the market people come and do trading on their own. Some facilitation can be done through various institutions, but it is kind of a direct market. So compared to those direct lending or borrowing, financial intermediaries can bring some analysis, some information to support decision making. So that's why you call it cost advantage. Reconciling conflicting preferences of lenders and borrowers. I hope you remember we looked at there are various requirements of these lenders and borrowers. So the financial intermediary reconciles those. Risk aversion means intermediaries they help spreading out and decreasing the risk. I told you, especially this adverse selection and moral hazard issue is basically reduced by the financial intermediary. And the last two, economies of scale and economies of scale scope. Economies of scale means now a financial intermediary can provide service to various people, a large group of people. So with that, what will happen? The unit cost would reduce. Unit cost reduce means if they only have few transactions, they have to incur a certain cost. But if the transaction volume increases by way of more lending and borrowing, they can reduce the transaction cost. That we call as economies of scale. It's like in a factory, you produce, let's say, one shoe, for example, pair of shoes. For that, you have to spend some certain cost. That certain cost involves labor cost and fixed cost. If you expand the production, what will happen? That you the cost for particular shoe will go down. Why? You are expanding the production means you are expanding the or reducing the unit cost. Now the fixed cost will be the same for all, but you are reducing variable cost would be increasing with the more production, but you are reducing the fixed cost. As a result, you reduce the overall cost. So we call it economies of scale. And then we have economies of scale, scope, which means a financial intermediary, when they provide service to lenders and borrowers, they can expand their service range. More products and services can be given. Now, for example, in a bank, you are, uh, let's say, taking a loan from a bank, or you are having a deposit with a bank. So that is the key product. You are having a deposit or you take a loan. But if you think you get some added services to those key product. For example, if you take have a deposit with a bank, you have a passbook, you have an ATM card, debit card. You can pledge your, if it is a fixed loan deposit, you can pledge it and get a loan against that. So those are some added features. If you are a borrower in a bank, you can have a current account, a checkbook, overdraft facilities. Those are some added features for a financial product, loan or a deposit. So these we call them as economies of scope. Okay. So financial intermediaries are directly involved or directly able to provide these advantages in the financial system. Now let's classify financial intermediaries, right? These financial intermediaries can be classified into three categories. What are they? Depository institutions are there, contractual savings institutions are there, investment intermediaries are there. So these depository institutions and other two, contractual and investment intermediaries, we can divide into two broad categories actually. Depository institutions and non-depository institutions. I think idea of depository institutions very clear. They are basically based on deposits. Contractual savings and investment intermediaries, they might not be based on deposits, but some other kind of a financial product. Could be an insurance premium, could be a pension fund contribution, could be an investment deposit, likewise. So this classification, if you look at Mishkin's book on financial markets, you will see a discussion on this classification. So in this textbook, I'm extracting this text table from the textbook because it's very helpful to understand some key products of these different institutions, different FIs. Now, as we have seen, the intermediary can be divided into three areas: deposit institutions, contractual savings institutions, investment intermediaries. Now, in this table, we can identify what are their main liabilities. Liabilities means how they mobilize funds, source of funds. Then how these funds are utilized, which means assets, users of funds, right? So from this table, you can see these different institutions have different sources of funds and different ways of using those funds. The way they get money are from different sources and usage of that money into different areas. So let's look at these different institutions and their products according to this table. Now, depository institutions, they are basically banks, right? We can include depository institutions as banks. Non-banks could also be there, but main category of depository institutions is banks. So what are now this table is from, as I said, Mishkin's book. So examples are basically from the US context. These are key institutions in the US economy, but some, if you look at, they are common to uh, our institutions as well, our economy as well. So what are the depository institutions? We have commercial banks. If you look at their primary source of funds or the liabilities, deposits, and how these deposits are used by these banks in assets, they give loans, mortgages, investments in bonds, right? Securities. If you take a savings and loan association, these are actually, you can call them as non-banks, NBFI, non-bank financial institutions, mutual savings bank, credit unions, all their source of funds is deposits. And they might be giving mortgages, loans, right? Broadly, deposits and loans are the main liabilities and assets of depository institutions. Here you can also add investments because commercial banks they are having investments as well. Even non-banks have, but very minimum at minimum levels. Second type is the first type. Second type, contractual saving institutions, where you have this insurance companies, pension funds. So insurance companies could be into two areas, life insurance companies, fire and casualty means general and life, right? Even in Sri Lanka, we have this type of insurance companies. So how do they source their money? Insurance companies, they get premiums from insurance product or the agreement. How do they invest those, use those insurance premiums? They buy bonds, give loans, right? Mainly they are buying bonds, which means investment is the main usage of funds. Third type, investment intermediaries. In US, they have intermediaries called finance companies. Now in Sri Lanka, what we have finance companies where we put under depository institutions. But in the case of US, they include finance companies as investment intermediaries, right? Then we have, if you look at their source of funds, they source money by issuing commercial papers, dealing in stocks, bonds, etc. How they use those funds, they give loans mainly. Mutual funds and money market mutual funds, they source money through issuing shares. How they use this money, they might buy bonds and stocks or money market instruments. Again, broadly, what we can see, investments are the main usage of money. So from this table, you can understand the primary assets and liabilities of financial. Now, even though I say these things, some particular institutions might have all these, right? For example, nowadays commercial banks they do a lot of things. They not only mobilize deposits. Some commercial banks they helping share issuances, helping uh, bond market activities. Even they can have an arm for insurance activities. So they are like very large holding companies. We call them as universal type of banks. But if you look at their prime business, you can uh, tabulate or like this. You can summarize like this. Now, based on these various three categories and their examples, you can identify a number of financial intermediaries in the economy. So I have listed those key institutions, intermediaries here, such as banks, finance companies, investment banks, merchant banks, leasing companies, building societies, microfinance institutions, credit unions, insurance companies, factoring companies, cooperatives, pension funds, escrow companies. All these are considered as key financial intermediaries in the economy. Now, in some countries, the prominence of these institutions are different. If you take Sri Lanka, our key type of financial institution is banks. Sometimes in Western countries, the key institutions are not the the normal commercial banks, investment and merchant banks. Right? So in some markets, insurance funds or companies are very big. But in general, we agree banks are the most important financial intermediaries in a financial system. Now, although we can identify them as financial intermediaries by looking at this list, we can give me a minute. Now, although we can broadly identify them as financial intermediaries and these different examples, now some financial institutions are providing non-intermediary services as well. Now, all these institutions I said, they are FIs, which means financial intermediaries. The role of financial intermediary, I think it is very clear in your mind. They collect money from surplus units and give money for deficit units. FI is in the middle, right? So that is the broad model that we are based on. However, some financial institutions, they are also providing non-intermediary services as well. For example, some are providing financial advisory services, which means helping clients to get financial decisions. Or sometimes they give advice on fund management, for example, how to generate returns and all that, and helping for that matter. These are called as non-intermediary services. And at the same time, sometimes we have already seen from the direct financial markets or direct finance, savers are directly lending money to the financial markets or other parties, which we call as financial disintermediation. Now, this disintermediation and non-intermediary services are also provided by financial institutions in modern world. Generally, we know they are providing intermediary service, but at the same time, as I said, in modern context, we can see these FIs are also providing non-intermediary services and financial disintermediary services as well. Why I am saying this, if you look at a balance sheet of a financial intermediary, particularly of a bank, you will see these activities. I will show you in a while, right? So I think with that, we have a broad understanding about financial intermediaries, a comprehensive understanding, why they are important, what they do, what type of institutions are there, what are their broader type of assets liabilities, and whether they are only doing financial intermediary service or do they do something else. Now we have some broad idea. Before we go into this list, I think I told you we have to define all these things by one to get to know about those institutions. I will also define financial service providers here. I told you financial institutions can be divided into two: financial intermediaries, we have already covered, and the other part is financial service providers. So what is the role of the service providers? They are basically helping or facilitating the transactions through various instruments and methods. Now, for example, I have given you a large number of lists here: fund transfers, remittances, credit card companies, issuance of financial guarantees, dealing in financial derivatives, payment service providing, money changing, dealership, brokers, exchanges, securities, depositions, safe custody, factoring, crowdfunding. All these are referred to as different financial services, right? Now, we will look at these things in our discussion. Okay. Now, let's go into details. First, we go into the details of different types of financial intermediaries, FIs, right? In this part, we will be looking at that list of institutions, starting from banks, because banks are the most important institutions, and other type of FIs, which are playing a sizable role in the financial system. Now let me go through these one by one. So let's start with banks. Now, I told you banks are the main financial intermediaries. Now, when I say banks here, some countries have different definitions. Now, if you take Sri Lanka, when I say banks, this includes commercial banks or specialized banks, both. Sometimes in some countries they have different terms. For example, in India they have a term called scheduled banks. Again, those are like commercial banks which have been licensed by the central bank. So irrespective of these different type of banks, what we are talking here is, in a broader sense, banks. But naturally, our discussion could be biased to commercial banks, because among banks, commercial banks are the most important institutions. Right? I hope you get my idea. Among financial intermediaries, banks are the most important. Among banks, commercial banks are the most important. So they are the key financial intermediaries. Now, banking has a long history. Especially it goes back to early stages of human civilization, even to this Greek Roman civilization. But a real or visible change, a development in banking industry has happened in the 20th century, especially after 1980s. Because many countries liberalized, we call it as deregulated, the financial markets in many countries, giving some free functioning to the banking sector. Free functioning means under the supervision of the central bank and its monitoring, the banks were given freedom for their business decisions, to decide their interest rate, to decide their loans, whatever the business decisions were allowed to taken freely without having any influence of authorities. That is what meant by liberalization. And also allowing transactions not within the borders or even beyond the borders. So in 1980s, what has happened? Most countries open up their banking sectors to foreigners, and also they started going beyond their boundaries. So this was also supported by the developments in information communication technology, because bank operations were much supported by this technology. So that has helped to expand their outreach into within the country as well as even beyond the geographic, uh, physical geographic boundaries, which means they could even operate in other countries without opening um, uh, number of branches. If you only have one branch, they can do a lot of things, because through the communication technology, the transactions and the the, the banking function became very convenient. Now in this list, I have given you the most largest or the top 10 world banks by 2020. This is only for your information. Now if you look at the list, you will see ICBC is the largest bank in the world. So their capital is $380 billion. ICBC means a Chinese bank. Other than that, China Construction Bank, China Agricultural Bank, Bank of China, all these first four banks are Chinese banks. Earlier, actually, this was a bit different. Now, in 1990s, early 2000s, the largest banks were either US banks or UK banks. But now you can see those have been surpassed by the Chinese banks. So China is even dominating the banking field in a global sense. And if you go down to the list, some banks, this JP Morgan, Bank of America, Wells Fargo, Citigroup, I think all these are well known banks. I think some are actually familiar for us as well, Citibank. So these are US banks which are considered as largest banks in the world. And you will see HSBC, it's a UK bank in the first 10 banks, and also one Japanese bank is also in the first 10, that is Mitsubishi Bank. So all in all, you will see this equation has changed compared to earlier. Earlier, this category was actually on top. This category was below. But now what really has happened, Chinese banks have become more prominent and dominant in the financial markets. Okay. Now let's try to understand a bank in a detailed manner. Now, bank is a financial intermediary. We already know it. What is their main role? Accepting deposits and channels those deposits into lending and investment. So you have to keep that in mind. A bank does both lending and investment. Traditionally, we know banks are taking deposits, giving loans. So this loans means this includes two. which means two things: advances, loans and advances, as well as investments. I'll show you a typical bank balance sheet, then you will understand banks are not only giving loans, right? So these are considered as highly regulated institutions in a financial system because of their importance to the system. I already mentioned to you banks are the largest financial intermediaries or most important intermediaries. For that matter, they have a systemic importance in the financial system. Systemic importance means if something has happened to a bank, that could also threaten the other sectors of the economy, other sectors of the financial system. For example, during a crisis, if banking sector goes into a crisis, it will be translated to other sectors as well, even to the real economic activities. That's what has happened in the global financial crisis. Originally, the issue came in the banking sector, arose in the banking sector, and then that translated to the broader economy as well. Because the banks are linked to other uh, sectors. The activities of the banks are impacting the other sectors as well. Okay, so we call them as systemically important financial institutions. Now, in modern world, we know the banks are really important because the economic activities, especially the transactions, cannot be done without a bank. And we know money is having various functions in terms of exchange, in terms of value, storing, and all that. Those functions can't be fulfilled without having a bank. So, in that sense, also, banks are playing a huge role, important role in modern financial systems. So here I have basically listed down the functions of banks. Now banks functions can be, identified in various ways. Now here I have given you a kind of a diagram. In that diagram, you will see functions of banks are divided into primary functions, secondary functions. So primary functions you already know, accepting deposits and giving loans, granting advances. So deposits means savings deposits, fixed deposit, current deposit, number of deposits called recurrent deposits, etc. Loans could be various from overdrafts, cash credit, loans, bill discounting, anything. So this is basically their primary function. And also modern banks, I already mentioned to you, have some other functions. You can put them under secondary functions, right? So these secondary functions are basically divided into two: agency functions and utility functions. So agency functions means fund transferring, periodic payments, collection of checks, portfolio management, right? Utility functions are issuing drafts, local services, underwriting, project report writing, social welfare programs, other utility functions. Likewise, now you will see here there are, in this case, basically they have intermediary service. In this case, they have non-intermediary service. right? So I think it's clear the banks are not only playing their key role in terms of as intermediaries, but some other functions are there. Now, if you take their intermediary function and their other key agency functions, they can or they are identified as providing some important services to the economy. In terms of credit intermediation, you already know banks are borrowing and lending. Borrowing means they take deposits or take loans and giving loans to others, right? Maturity transformation is done. They basically collect money in the short run and giving loans for the long term. Deposits are short term, loans are long term. They help in payment and settlement. From these agency functions we have seen, they do fund transferring, payment settlement activities, clearing. That is also an important function. And from our knowledge on money, we know how important banks are in terms of money creation, right? I hope you remember banks are keeping a reserve at the central bank in terms of reserve ratio. We call it as fractional reserve banking. Through that activity, banks are creating money in the financial system. Okay. Now let's look at bank business, because we are looking at this bank business based on these various functions played by them. Why we need to understand this bank business? To understand their balance sheet structure and their key functions. Now banks are doing their business for a profit. They are not a kind of a charitable agencies, right? It's not a charity. They are there to fulfill market needs. And why do they fulfill market needs? To earn a profit. So how do they earn a profit? Through their activities in relation to asset purchases and dealings in the assets. So for that matter, you can identify major type of businesses of banks in terms of deposit taking, borrowing, lending. I think I told you these are the most traditional type of activities. A bank is becoming a bank because of this deposit taking and lending. And not only that, banks are also providing investments or doing investments, and also we have seen they have payment and other financial services. See, remember these agency functions, they are related to payment and financial services. Now the bank's business model is aimed at generating a revenue. So banks are having a business model to generate a revenue. Now this revenue in general, we have two major components. What are these two major components? First one, they have revenue generated through interest rate. That is basically interest revenue. And they also have a component called non-interest revenue, which are generated through other modes of income, like fees and charges, right? So this is their revenue function. They have interest based income, non-interest income. Interest income is from their normal banking activities, giving loans and doing investments. Both generate interest. Non-interest revenue is basically coming from activities other than the normal lending business or investment business. This non-interest income may be coming from various other functions such as the agency functions and utility functions, which means, as I said, non-intermediary services. For example, if a bank is giving financial advice to someone, for that financial advice, the bank can charge a fee. So that fee is captured in non-interest income. So banks are also having cost, right? So the cost of the bank is basically coming from, again, the interest related cost, which means for their deposit taking and for borrowing, they have to pay money. So they have to incur some cost, interest cost. And also some other costs are also there. Operational cost, running cost, system related, and all this we can simply call operational cost. So this is their cost function. So the difference between this revenue and cost is their profit, right? Now simply this profit you can attribute to the difference between the deposit interest cost and the loan interest cost in very simple form. If you take a bank, the profit simply is the difference between the interest paid on deposits and the interest earned on loans and investments. But you would see from this, not only those deposit and loan based interest income or cost, there are some other non-interest and uh, other type of incomes for a bank. Okay. So as a result, banks' business activities can be divided into two areas: on balance sheet activities and off balance sheet activities. Now, this slide is important because this was an exam question. The definitions of these on balance sheet and off balance sheet activities. I'll come into those definitions in the next slide. So banks are generating income through both type of activities, on balance sheet and off balance sheet. So the bank's revenue is composed of both. Total income of a bank is derived from both on balance sheet and off balance sheet activities. Now let's look at what are the on balance sheet activities and what are the off balance sheet activities. Now on balance sheet activities are the activities mentioned in a bank's balance sheet or in financial statements. Now, if you take a typical financial statement, assets liability statement, you have assets and liabilities. Right? Now on the asset side, what is written is basically what banks is owned under their name. For example, on the asset side, banks have cash, investments, loans, fixed assets. Those are the major items. They have cash, investments, loans and advances, fixed assets. Those are the key items on the asset side. So these are what is owned by banks. And also banks are required to honor to some other parties in terms of liabilities, which means the banks need to pay back to those owners. These are kept by the bank for a short term, acquired for a short term. What are they? Mainly deposits, borrowings, capital. Deposits, borrowings, capital. So in the balance sheet, you would see assets are given on the asset side, which is owned by the bank. On the liability side, deposits, borrowings, and capital, which are basically banks need to pay back, or which means they owe to pay back. Now, all these are written on the balance sheet. So, you call it statement of financial position. So, banks are engaged in business activities related to these on balance sheet activities, either deposit taking, doing some borrowings, accumulating capital. All these are written on the liability side. On the asset side, they are cash position, investments, their loan portfolio, fixed assets, all are written on the balance sheet. So through the transactions of these items, banks generate revenue. You can call them as revenue generated by the on balance sheet activities. Now, these on balance sheet activities actually generate what type of income? In this equation, which I mentioned here, this interest related income is mainly generated by these on balance sheet activities. So banks earn interest on lending and investment, and they have to pay interest on their deposits. That leads to generate a profit based on interest income and interest expenses, which means related to their interest based or on balance sheet activities. So as a result, we call these on balance sheet activities as fund or interest based activities. Fund or interest based activities. So deposit taking is a fund based activity. Loan portfolio is a fund based activity. Banks doing an investment is a fund based activity. Okay. Banks borrow from others for their needs. That's a fund-based activity. So these fund-based activities are simply indicating the interest-based activities. Now this is related to, I think in commercial banking you would learn this concept of net interest margin, NIM, which means the difference between interest income and interest expenses. So net interest margin is a function, it's an important component of on-balance sheet activities because that is generated through the activities written on the balance sheet. So here we have a sample example to understand this. Again, this is a typical balance sheet of a commercial bank or let's say banking industry. Uh, this example is from Mishkin's book. So this reflects the banking system of US. Now what do we have? We have asset side and the liability side of the banking system. Asset side indicates usage of funds, liabilities indicate sources of funds. We already know. Now, what are the key asset type of this balance sheet? If you look at reserves and cash items. Remember, I told you cash. Then you have securities. Securities in government, US government, agency, state securities, local government securities. I hope you remember I mentioned these I investments. Then they have loans, commercial loans, real estate loan, consumer loans, interbank loans, etc., etc. So these are loan assets, right? Then they have other assets, for example, physical capital, equipments. So those are fixed assets. So these four categories of assets are written on the balance sheet. So which means on balance sheet activities. On the liability side, if you look at, they have checkable deposits and non-transaction deposits. Both are what? Deposits. Then they have borrowings. Borrowings means what they have borrowed for their activities, B. Then they have capital, which means money contributed by the shareholders. So all these are written on the liability side of the balance sheet, which are off balance sheet, sorry, on balance sheet activities, right? So this is a sample balance sheet of a bank. Now I have an example from a Sri Lankan bank. This is again on balance sheet activities. If you look at the asset side, you will see these items that I have mentioned. Now these first few things, cash, balances with the central bank, placement with banks, reverse repurchase agreements, all indicate cash assets, right? Then here you have financial assets held for trading, trading pledged as collaterals, etc., etc. Those are investments. Then you have loans and receivables to banks, loans and receivables to other customers, other loans and receivables, which means loans and advances. Again, here also you have some investments mentioned, but we have already identified investments. Then you have property, plant and equipment, intangible assets, etc. These are fixed assets. All are written on the balance sheet under assets. If you look at liabilities, what do they have? Due to banks means you have to pay other banks, which means borrowings. Here you have due to other customers, which means what you have to pay other customers, ordinary customers. That indicates deposits. Right? There are other number of items as well. I'm not going into details of these items, but broadly what we are trying to identify is key items in the balance sheet. Then we have the equity part in the balance sheet, which indicates capital. So borrowings, deposits, capital. These are on the liability side of the balance sheet, again on balance sheet activities. Right? The point is the banks are generating interest-based revenue using these on balance sheet activities. Okay. Then we have off balance sheet activities. These are activities, could be an asset activity, debt activity, or any financing activity not recorded in the balance sheet. So in this asset liability structure, these off balance sheet items are not included. So they are included or mentioned beyond the balance sheet. So which means these are not creating any asset or a liability on the balance sheet. So we call them as contingencies and commitments. Now, for example, banks are engaged in various financial services, giving advisors and all that, credit appraisals, all these investment support. These are not included in the balance sheet. Derivative transactions not included in their balance sheet. Letter of credit giving guarantees, security underwriting, entering into foreign exchange contracts, forward contracts. None of these are included in the balance sheet. So we call these activities as off balance sheet activities. Why? It's not written on the balance sheet. Now these off balance sheet activities are linked to what? Fee-based income. For these services, banks are charging a fee or a fixed charge. If you open an LC, a bank would charge a fee. If you ask for a financial service from a bank, advisory, they will charge a certain amount. So you call them as fee-based income. In this revenue equation, remember, I told you non-interest based revenue. So that is related to this fee-based activity. Okay. Now here I have an example from a Sri Lankan bank for these fee-based activity, off-balance sheet activities. Now, I told you these are not mentioned in the balance sheet. Assets, liabilities, structure, you cannot identify this. So where do you have this? This is beyond the balance sheet. So this is mentioned outside the balance sheet. We call them as below the bottom line of the balance sheet. Now below the bottom line of the balance sheet, you will find a line item called commitments and contingencies, CCs. Commitments and contingencies means these are committed. Contingencies means some temporary basis. Once the transaction happens, this could come to a permanent transaction and it could be included in the balance sheet as well. Now, for example, in some banks, they have commitment for a loan line or a credit line. for a particular person. So until that loan is taken, it stays as a commitment. So it's an off-balance sheet item. When the loan is actually granted and utilized, it could be a balance sheet item. That's why you call it commitment. Contingent liabilities are, as I said, among these transactions, derivative transactions, opening LCs, giving bank guarantees, all these are considered as contingent liabilities. Forward exchange contracts, currency swaps means derivatives. For derivatives, bank don't earn any interest. They earn a fee. Sometimes you call it a swap point. These details are given in the notes to accounts, right? Now you wonder where can we find these details? These are given in the notes. The total number is given here, commitments and contingencies below the balance sheet. But this number is explained in the notes to the accounts in detail. Okay. Clear?
Sir,
Yes.
as model in the balance sheet, are they mentioned the commitment and contingent expenses? That's mean the income or what profit, the total
In,
amount.
in the balance sheet, you don't have commitments and contingencies. Those are off balance sheet items. So that is mentioned beyond the balance sheet. Below the bottom line of the balance sheet, you have this line, commitment and contingencies. To see what are these commitments and contingencies, you have to go to the notes of the accounts, right? Now, at this stage in our exam, you don't need to, worry to that extent. That will be done in your commercial banking part. But I wanted to explain the bank business model. This R is not only interest, right? The interest related transactions are reported in the balance sheet, but there are transactions not reported in the balance sheet as well. Those are non-interest based activities. Non-interest based activities also done by banks because banks see this as a more stable way of earning income. Now, interest rates are changing in the economy, isn't it? But non-interest income it could be stable because every time interest rates doesn't, those fees do not change, even though interest rate changes. Okay.
Thank you, sir.
Yes. And if you look at all these bank activities, you can identify various types of banking. Any bank could be doing any of these or all, right? Some banks do retail banking, which means dealing directly with individuals and small businesses. I think we do retail banking with banks. Some banks are doing business banking, which means providing services to mid-market businesses or some reasonable sized businesses. Some banks are doing corporate banking. Corporate banking means they are directed at large business entities, conglomerates, or listed companies. Some banks do private banking, which means providing the banking services to high net worth individuals and families. Now, I think this private banking concept has evolved into personal banking. Even for us, this personal banking is provided one-to-one service, right? Through the phone, through the computer. Even we can have this private banking as a mode of personal banking today. Some help with investment banking, which means activities related to financial markets. Now, some of the banks are doing all, but some banks are famous for some of these activities. Now, for example, in Sri Lanka, foreign banks are popular for this corporate banking, right? Now, if you look at some our state banks, they are popular for this business banking because they are helping this mid-sized market entrepreneurs. All banks do retail banking, right? So likewise, Their specialty could be varying, but in general, most of the banks do all type of banking. And also in modern context, you can look at some different classifications of banking. Now, one area is offshore banking. Offshore means simply providing banks to uh, entities beyond the geography, which means providing services to foreign companies. Now, for example, in Sri Lanka, our banks are having a unit called Foreign Currency Banking Unit, or OBU, Offshore Banking Unit. So this unit provides services to foreign companies and foreign entities. And also other area is universal banking. Universal banking means providing services under one roof for various activities, right? Providing banking services, providing non-banking services, insurance services, investment activities. Most of the type of banking services are provided into this under this universal banking concept, right? So all these are provided by way of all of our actions. We already know this: deposit taking, borrowing, lending, investment, financial services related to these activities. Now, what I want to discuss in detail next is the risk, okay, faced by banks. Now, these risks are also related to the broad financial market as well. Now, I'm going to do this next week. I have a request here for you to look at exam questions related to this risk, okay? Because that part is really important, understanding the risk. So please look at the exam questions before you come to the class next week. And I'm going to discuss this risk along with the exam questions. I hope you have the papers and marking schemes by now. So look at these questions related to risk in the past papers. There are a number of questions as I remember. So have a look into those questions and we will have a discussion in the class, and also risk management aspects. And that day we are going to finish these all institutions, and if there are any questions related to intermediaries, we will be covering that day. Okay. So I'm going to stop here today because I need to have some more time spent on this credit or the risk part with some exercises as well. So I'm going to stop here today. Do you have any questions? Let me check your chat box.
So why don't we add these non off sheet balances in the PNL?
In the PNL, the any profit or loss you generate will be captured in the PNL. What we are saying is it is not included under the balance sheet. Balance sheet means not the PNL, right? PNL is
And
you
financial, yeah, I want to know the balance in the balance sheet. We don't add any fee based activities, is it?
no, in the balance sheet, no.
Okay.
If you take the balance sheet of a bank, you would see all activities are related to their, uh, as
Just
I mean,
interest based.
interest-based activities. But that income comes to the P&L. Okay. Is the Sri Lanka recent borrowing from Bangladesh is a currency swap? Yes, Kasuni, it's a currency swap, which means exchange of dollar and rupee for a period. Okay, let's stop here, and I'll see you next week at the same time with the balance part of the discussion.